Meet Jake and Marcus. They're the same age, live in the same city, and earn the exact same $55,000 annual salary. More importantly, they both just managed to save exactly $50,000, but they're about to put that money into completely different wealth machines. Jake uses his $50,000 as a 20% down payment to buy a $250,000 three-bedroom rental property. He takes out a 30-year mortgage, secures a 7% interest rate, and gets the keys. This visual equation shows Jake's immediate profitability. His monthly mortgage payment comes out to roughly $1,330, and he finds a tenant willing to pay $1,800 a month. On paper, that leaves him with $470 in pure monthly profit. Marcus takes his $50,000 and drops it into a total stock market index fund, a single, highly diversified asset that buys him tiny slices of thousands of different companies. He automates a $300 monthly contribution, logs out of his brokerage account, and goes back to his normal life. On day one, Jake wins the psychological game by a mile. He owns a physical structure he can drive past. Rent checks hit his bank account on the first of the month. Marcus simply has a confirmation email and a number on a screen that occasionally ticks up or down. Basic arithmetic makes the rental property look like an obvious, immediate victory. But relying on a simple subtraction problem on a napkin ignores the heavy friction both of these investments will face over a 20-year timeline. By year 3, Jake has collected roughly $64,000 in gross rent. But that top-line number is about to be heavily filtered by real-world friction. This waterfall chart illustrates where that rent check actually goes. First, subtract $3,000 a year for property taxes and another $1,500 for insurance. Then subtract the unavoidable maintenance crises, a $1,200 water heater replacement and $2,800 to fix a leaking roof. We also have to account for the average rental property. It sits empty for about 1 month per year between tenants. During that month, Jake pays the full mortgage out of pocket, alongside cleaning and listing fees. And because he self-manages the property to save on management fees, he effectively works an unpaid part-time job answering maintenance calls on his lunch break. When you tally up the actual costs by year 5, Jake's cash-on-cash return, the actual money he pockets relative to the $50,000 he put in, is hovering between 3 and 5%. Over those same 5 years, Marcus is doing absolutely nothing. His portfolio grows a little, shrinks a little, and grows a little more. There are no midnight plumbing emergencies, no tenants to screen, and 0 hours of physical labor. Maintaining the value of a physical property requires continuous active labor and a steady stream of capital. The stock portfolio demands nothing but passive patience. Fast forward to year 10. Jake's property has quietly grown in value thanks to the primary engine of real estate wealth, 5-to-1 leverage. This visual model shows exactly how leverage works. Jake used just $50,000 of his own money to control a massive $250,000 asset. Because he captures the appreciation on the entire property value, a modest 3 to 4% annual increase multiplies his actual equity rapidly. Marcus relies on a completely different engine, compound interest. It is a mechanism that feels painfully slow in the beginning because the initial principal is small. This curve graph reveals the exact inflection point of Marcus's strategy. Right around year 7, the historical gains on his initial money begin generating more new wealth each year than the $300 he deposits every month. The compounding begins to accelerate. By year 20, the math solidifies. Jake's property is worth roughly $500,000. His mortgage is nearly paid off, and after accounting for 2 decades of rent, repairs, taxes, and at least 1 major renovation, his total net worth from this single asset sits between $400,000 and $500,000. Over that exact same 20-year period, Marcus's initial $50,000, combined with his total monthly contributions of $72,000, has compounded into approximately $420,000 to $460,000. These strategies utilize completely opposed economic mechanisms. One requires heavy debt and active management. The other requires total passivity and reinvested dividends. Yet, given enough time, mathematics equalizes the raw financial outcomes. Since the final dollar amounts end up in the same ballpark, the real distinction lies in the currency each man paid to get there. Jake paid with physical exertion. He spent weekends coordinating repairs, managing tenant turnover, and accepting the risk of tying his wealth to a single structure in a single zip code. This is a snapshot of the Financial Times from September 2008. It illustrates Marcus's payment method, enduring severe psychological volatility. He didn't have to fix a leaking roof, but he had to watch his net worth plummet and actively resist the urge to panic sell. The historical data proves how brutal this ride is. In 2008, the market dropped 37%. In March 2020, as seen on this trading floor display, it dropped 34% in a single month. Sitting on your hands while your portfolio bleeds out requires immense discipline. There are highly specific scenarios where physical property dominates. If Jake utilizes house hacking to drop his own living expenses to zero, or defers his capital gains taxes by rolling profits into bigger properties through a 1031 exchange, his wealth generation can easily outpace index funds. Conversely, Marcus holds a distinct mathematical advantage in scalability. If he simply increases his automated contribution from $300 to $500 a month, his 20-year portfolio jumps to nearly $600,000. He scales his wealth with a few clicks, whereas Jake would have to take out a second mortgage and double his workload. Neither path is universally superior. The true trap is selecting your financial strategy based on a YouTube thumbnail or an anecdote from a coworker, rather than sitting down to run the strict mathematical calculation for your own life.